Ladies and gentlemen, good day and welcome to the Sanghi Industries Limited Q3 FY22 conference call, hosted by PhillipCapital India Private Limited. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star and then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vaibhav Agarwal from PhillipCapital India Private Limited. Thank you, and over to you, Mr. Agarwal.
Thank you, Inba. Good afternoon, everyone. On behalf of PhillipCapital India Private Limited, we welcome you to the Q3 FY22 call of Sanghi Industries Limited. On the call, we have with us Mr. Alok Sanghi and Ms. Beena Engineer, full-time directors of the company. I would like to mention on behalf of Sanghi Industries Limited and its management that certain statements that may be made or discussed on this conference call may be forward-looking statements related to future developments and the current performance. These statements are subject to a number of risks, uncertainties, and other important factors which may cause the actual developments and results to differ materially from the statements made. Sanghi Industries Limited and the management of the company assumes no obligation to update or alter these forward-looking statements, whether as a result of new information or future events or otherwise. I will now hand over the floor to Ms. Beena Engineer from Sanghi Industries for opening remarks, which will be followed by interactive Q&A. Thank you, and over to you, ma'am.
Thanks, Vaibhav. Good afternoon, everyone present on the call. We discussed the performance of the company for the quarter ahead and 9 months ended 31st December 2021. This quarter was a mixed quarter in the sense that we have had one of the highest realizations and pricing during this quarter, but at the same time, the power and fuel cost has been burdensome for the company. I'll take you through the numbers and then we'll be open for the question. During this quarter, we have had total sales of 6,01,000, out of which 1,55,000 ton was clinker, which is up by almost 5 times from 29,000 in the immediately preceding quarter. Cement sale was 4,46,000. This is 15% better than the immediately preceding quarter. However, it is around 29% lower than the December 20 quarter. We have to see December 20 in the backdrop that first 6 months were lockdown and all the pent-up demand had been released in December 20 quarter, and therefore we are talking of a higher base for December 20. In terms of geographical mix, we have done around 86% sales in Gujarat, and outside Gujarat we have done 14% domestic cement sales.
Am I speaking with Veera? Veera, are you an individual investor? Hello? Hello? Veera, this is the operator.
Compared to the previous quarter. Total cement sales that we have achieved on gross basis was 347 crores, which is 7% lower on a December 20 comparison, but it is around 29% better than the immediately preceding quarter of September 21. The net sales was 278.5 crores, which is 4% lower compared to 289 crore of December 20, and compared to September, it is at least 32% better. In terms of the prices, we have seen rise in the range of about 350 rupees across the western market, including Gujarat, Maharashtra, Rajasthan, MP, etc. And Kerala, since we are doing ex-terminal sale, that was around 275 rupees. Therefore, the average was 343 rupees gross price. In terms of various costs, raw material cost has more or less remained static. The addition has arose because of the higher volume of production. Partially, there is a bit of regrouping of certain costs which were otherwise captured in other expenses. Now, following the new format, it has been captured as a part of the raw material. So these are and there are some additives which have been improved to further improve the quality and of the cement, and therefore the additive cost has gone up marginally. The main impact has come on account of the power fuel cost. In line with the international trend on energy prices, we have also experienced nearly 100% increase in our coal price, and therefore the CV cost has also gone up from about 85 paisa to 1 rupee 92 paisa. So we have seen between 100 to 125% increase in the blended cost of the fuel. To offset this, we have taken some immediate measures. One is that we have enhanced our lignite usage, which on a 9-month basis has increased by at least 4 to 5 times, and particularly in the last quarter, we towards November, December, we have enhanced the lignite usage, including which has continued in January and February also. We have used almost 10,000 ton equivalent of alternate fuel, which adds to our other income. So there is a sharp jump in other income, which is on other operating income, which is on account of the use of alternate fuel, where we are also being paid by the supplier, as well as we are able to save on our energy cost to that extent. So that is another factor, another initiative which we are pushing to reduce the power fuel dependence on the imported coal. In terms of store fare packing cost, there is no significant change. Selling distribution cost is also more or less maintained, except about 4 to 5% increase, which has happened on account of the diesel price changes. On 9-month basis, we have seen that the overall gross sales has increased by 24% in comparison, and overall volume of cement has moved up by 15%. So that is the comparison for 9 months. This is all from our side to begin with. And
ma'am, can you open the Q&A?
So maybe open the lines for questions.
Yes, I think we can.
Thank you.
I think Ladies
and gentlemen, we'll now begin the question and answer session. Anyone who wishes to ask a question may enter star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who has a question may enter star and 1. We'll take our first question from the line of Rajesh Ravi of HDFC Securities. Please go ahead.
Yeah, hi ma'am. Good afternoon. Would you share the production number for the quarter, please? Cement and clinker.
So generally, we don't announce production numbers. We are only announcing the sales number, and I'm continuing to do so. There was a good production during the period, and clinker utilization has improved significantly over the previous quarter. But
Okay.
we would resist from going for the production number. That won't have material impact. I mean, the entire impact is based on the sales.
Mm-hmm. No, because you're right, because what seems 50 odd crore of stock adjustments, which implies that there's a large clinker inventory seated at December end. Okay, would you...
That is quite right. That is what I'm saying, that we had good capacity utilization during the period, and since we were also focusing on clinker export, there is a good amount of stock lying at the end of the period.
Okay. So now second is, how about the new line? How are they operating? What is the utilization you have received on the new clinker line, which is under, which is yet to be commissioned?
So we are taking production from the new clinker line as well as existing clinker line. And overall utilization, as I said, has been good. and we are slowly reaching the peak performance of that line also, and we are doing the final tests, etc., during the current month now, and things are under control. They are looking good.
Okay. And any thought on the clinker export? What is the opportunity you're looking at on a recurring basis?
Alok will reply to that.
Yeah. So clinker export is quite robust. The demand internationally is quite strong. However, the challenge we are facing is that we have seen a sharp increase in the energy prices. This may not be true in most areas. In some of our competition countries like Iran and other places where they're using gas. So they haven't seen this kind of sudden spurt in energy prices. So which is why even though we have exported clinker in this quarter, the margins are very weak. And so while it's a good opportunity in the long term, but currently the margin profile of the clinker export is weak.
Okay. So if I look at it for you, even if you are able to fetch some positive contribution, given that your capacities are underutilized, wouldn't this be a lucrative opportunity for you, even if the margins are low?
Yeah. So that is exactly why we have exported even in Q3. When the domestic market was little sluggish, we were able to export clinker. But like I said, we are just breaking even on the clinker exports because of the sudden jump in energy price.
Okay. And on the energy cost, could you share what was the per kilocal average blended costing for you in December quarter and in September quarter, and how do these costs stack up in the March quarter?
So typically the blended cost, I had mentioned that they have moved up to about 1.92 rupee during this quarter.
Okay.
And as I said, we are making efforts to enhance the lignite consumption, and the lignite procurement and quota has actually gone up during current month. Therefore, we expect the lignite component to be more in the overall fuel mix. Secondly, we have enhanced the alternate fuel mix significantly in this, and therefore these are the two positives. However, I have no prediction on the coal prices because the situation was still difficult in Indonesia in January, and things are slowly easing up. But we have to wait and watch how it unfolds over next 2 months.
Okay. No, in January, this 1.92 rupee went up, or are they still stable in January consumption cost?
We haven't made any significant fresh purchase during the period, so during January, so we will not be able to comment on that. But
okay. Please go ahead.
Yeah. So just I can add a little bit on the market side. The coal market continues to be quite hot. The energy prices have again started moving up after coming down. In the end of Q3, so December, January, we saw a little bit of an improvement in price of coal, and we expected it to stabilize. But again, from February, the prices have started slowly moving up. So I believe that we must now realize that this may be the new normal, at least for the next 3 or 4 months, and then maybe after that, we may see some improvement in the coal price, internationally.
Okay. Great, sir. I'll come back and queue. Thank you. All the best.
Thank you.
Thank you. A reminder to our participants, if you wish to ask a question, you may enter star and 1. Ladies and gentlemen, if you wish to ask a question, you may enter star and 1 on your touchtone telephone. Our next question is from the line of Nirbhay Mahavar from N Square Capital. Please go ahead.
Yeah, just wanted to hear your thoughts on the demand side, which has remained pretty muted for last 2-3 years. Is there any change you are seeing in your key markets?
Yeah, so our key market is Gujarat market. In Q3, like what Meena mentioned already, that we are sitting on a high base, and therefore anyways across India the expectation was that demand will be lower compared to previous year. In our region, we had a demand destruction of almost about 11% in Gujarat market. This was prolonged because of 3-4 factors in macro terms and little bit internal issues. So from macro perspective, we had an unseasonal rain impact which was continuing right up to December. So coupled with high prices and little slow demand, we could not experience good demand improvement in Gujarat. So specifically, if you look at it in the month of November and December, the demand destruction was close to about 20%, which caused a lot of turbulence in the market. The good part is that Gujarat market, despite the slower demand, remains consistent with its price. So we did not see the kind of price correction that we saw in other regions. Secondly, coming to the outside Gujarat market, so Kerala, we had impact of Omicron lockdowns as well as, again, unseasonal rain right up to December. So the demand in Kerala market was quite slow. We also saw a sharp reduction in price in Kerala market, which is unprecedented. Generally, Kerala market prices are quite strong, but we actually saw prices in Kerala lower than even Gujarat market prices. And so, the advantage to transport and sell in Kerala market was not there for the company in this quarter. The internal issue which we faced was that as you can recall, in Q2 we had a transport strike because of the sudden jump in the diesel prices, which continued for in the beginning of October. So when the demand was good in October, as a company we suffered in the first 15 days because of the spillover effect of the strike. But after that, everything started normalizing.
So sir, just wanted to understand, like, we have got capacity utilization less than 50% now, and that has remained so for quite some time. So with production constraints now going away, are we all set to gain market share in terms of, like, is that aggression to get back that market share is coming for the company? Or
please go ahead.
Or probably we'll have this kind of, like, we'll continue to have a muted volume growth to maintain pricing.
Yeah, so I have always stated that there is a change in heart, and we believe that trying to gain market share very aggressively at the cost of price and margins is unproductive for the company, because while you may gain about 10-15% additional volume, but the cost at which you are able to gain that, which is your 90% existing base, is not worthwhile. So I'm okay with a slow ramp up, but like I have always mentioned, that our target is that we will be able to go to full 100% capacity utilization or near about that in the next 2 to 3 years, depending on how the demand unfolds. The way I'm looking at it is that we have enough demand green shoots which are opening up in our region, and with this budget being very infrastructure led, I also foresee that the next 2 to 3 quarters we'll see very good demand growth in our region. So I'm not too worried about the volume ramp up strategy. But again, like I want to reiterate, we will not do it at the cost of price and margin. It is, I feel, not lucrative to try and ramp up very, very quickly by sacrificing margins and prices in our region.
So when you say 100% utilization in 3 years, what do you mean by in terms of cement volume?
See, so the maximum I believe we'll be able to hit with the existing grinding capacity is about 5.5 million tons, taking the impact of season, so the monsoon period. So I believe that we'll be close to about 5 to 5.5 million tons of total sales in the next 2 to 3 years. Now that depends a little bit on how the demand opens up for the company, and how quickly we are able to ramp up. So, but the prediction is that in the next 2 or 3 years, we'll be able to get to our rated capacity of 5.5 million tons of steel.
Okay, thank you.
Thank you. Any participant who wishes to ask a question may enter star and 1. Our next question is from the line of Gaurav Birmiwal from Credit Suisse. Please go ahead.
Hello. Thank you for the opportunity. Could you please repeat the volume numbers for the current quarter and the September quarter for these 2 quarters?
Yeah. The total sales was 601,000 ton in December 21, which was 416,000 in September 21. Out of this, clinker was 155,000 tons compared to around 30,000 tons in September 21. And cement domestic, overall cement volume was 446,000 compared to 386,000 in September 21.
Thank you, ma'am. Very helpful.
Thank you. Any participant who has a question may enter star and 1. Our next question is from the line of Prateek Kumar from Antique Stock Broking. Please go ahead.
Yeah, good afternoon, sir. Good afternoon, ma'am. First question is on, talked about week November, December. How has the volumes trended in the month of January and February? Has there been any recovery on an year-on-year basis, I'm saying, not on sequential basis?
So on a year-on-year basis, January was okay. I would say that we are still little lower than YOY numbers, but marginally. So it seems that demand is coming back strong. Again, we must remember that in the month of January, some of the markets were closed because of the lockdown situation, and construction activity was restricted in some of the areas to try and control the spread of Omicron. But now I feel with February coming in, the fears of massive wave is now out, and we are seeing improvement in on-ground activity. We should also remember that a lot of construction companies are impacted with the sudden spurt in the prices. So a lot of government contractors have fixed price contracts, and with the sharp jump in cement and steel prices, they are not making any return, and so they are negotiating with governments to try and revise their contract and so on and so forth. And therefore, there is a little bit of a slow pickup in construction activity in our region.
Sure. And sir, on pricing, so what would be our average price now in February, like versus what was there in December, in markets of Gujarat, Maharashtra, and Kerala?
Yeah, so prices for us are very stable. Gujarat market is, I think, one of the best performing markets in India in terms of price stability. Even though we had lower demand, we did not see a price destruction. In fact, if you look at it on a YOY basis, Gujarat prices are better by about 20% in Q3. We are stronger than Q3 pricing in January, and it is continuing even in February in our core market of Gujarat. The same, if you look at it from, let's say, Rajasthan or Kerala perspective, or Maharashtra perspective, the prices have been quite weak in all other regions that we are operating in on a YOY basis in Q3, and even today the prices are little poor in compared to Gujarat prices in Q4 also.
So how much is Q4 better than Q3 in terms of rupees per bag?
So see, the important thing to notice in Gujarat market, and I mean you should look at the historical data also, that prices in Gujarat have never fluctuated too much. Either it has not gone up by a significant jump immediately, or they have not even fallen by that much amount. So even though demand is hot or slow, the price movement is very marginal. So for example, the price may be better by about 5 to 10 rupees in this quarter compared to Q3 price. And I believe that this is the trend, it will continue. The price will move by not more than 5 to 10 rupees in our region, at least for next 4 to 6 months.
But isn't that too less for compensating for the kind of inflation which we are having in our markets also? So while there are attempts of higher price increase.
Let's look at announcement versus implementation. So many regions announce price increases, very sharp price increase of 50 rupees, 70 rupees, and so on. But the actual ground implementation is missing. And so ultimately, what happens is you have made a price increase announcement and then passed on a PE or an RD to the network. So ultimately, as a company, you don't end up benefiting. The evidence is there in the data. If you look at the prices in all other regions, the price movement has, while there has been a lot of volatility, the net benefit to the company has not come through. And therefore, even if you look at Q3, Gujarat prices are better by 20%, which is probably the best in the country. Nowhere else where there has been wide fluctuation in prices, you have managed to see this kind of an improvement in price realization. So I believe the change must be that it is important to focus on price stability so that there comes a predictability in the minds of the consumer of what is the cement price and they can do their costing accordingly. Wide fluctuation and volatility in prices has not benefited either the consumer or the producer, in my opinion.
Okay, and sir, any specific target for FY22 in terms of volumes? Now we are like closer to the end, so would be 2.3 million tons?
Yeah, so if you just give me 1 second. I think a 2.1, 2.2 million is a fair estimate for this year.
And sir, target for capex for FY22?
No, we are not looking at any significant capex during the next year. It would only be basic maintenance capex mainly for line 1, which is normal.
Sure, sir. Sure, ma'am. Thank you and all the best.
Thank you.
Thank you. Any participant who has a question may enter star and 1. Our next question is from the line of Giriraj Daga from KM Visaria Family Trust. Please go ahead.
Yeah. Hello, Bina ma'am. So my question is related to last year. The Feb and March were quite very hectic in terms of the activity, and we had a very good demand perspective. Do you think the industry would be able to grow year on year in Gujarat for the fourth quarter? Well, as you said, mentioned the ground activity is looking good in the February so far. So what is your take there?
So, at least in January, we have not done better than YOY figures. We have we are slightly short by YOY number. I'm not too sure whether we'll be able to surpass last year's number, but as a company, I believe that we will be able to do better in Q4 compared to what we did last year.
Okay, and particular cement sales. So I'm just segregating between cement and clinker.
Yeah.
Okay. Second, in terms of cost, do we expect incrementally the cost to go up from quarter 3 to quarter 4, or the majority of the cost what we are seeing? So what are the benefit what we saw that lower coal prices to an extent is some part in quarter 3 that must be reflecting part in quarter 4. Is this the right assumption?
Yeah.
Quarter 4 sorry. Yeah, look, you can continue.
Yeah. So what will happen in Q4 is that one is that coal prices will continue to hover in this region. The international coal prices will continue to remain in this region. So I don't expect this to come down sharply. What will help us improve is our overall blend mix. Like what Veena was mentioning, we have started getting a better allocation of lignite from GMDC. And we have started to push a lot more alternative fuels. Because of this, I believe that we are probably at a peak cost. We are not likely to see too much improvement or too much escalation in the cost number from at least in the next 3 to 4 months. This is my prediction on the coal prices. In terms of the cement prices, I believe that the cement prices have to move up with demand opening up further. These prices at the current coal prices are not really sustainable for industry to make healthy returns.
So I believe with demand opening up in the next 2 or 3 months, the cement prices across the country must move up a little bit, which will help us aid the improvement in margin profile.
Okay. Have you taken any price increase from 1st Feb onwards?
Yeah, like I said, Gujarat prices don't move very significantly, so you don't hear any headline announcement. But 3 to 4 rupees price improvements keep coming every month or so.
Okay. That's the last question from my side. Looking at the current rate, is it the current spot mix? Obviously, that will reflect in the Q1 if you buy anything now. But is this broadly similar to what we saw in Q3, or the current mix coal prices are higher compared to, let's say, Q3?
No, I think it is pretty much similar. There may be little improvement, but you see, we are also ramping up our production. So, what is happening is while you are getting a total increase in allocation of lignite, but because your total consumption is also going up, the percentage may not change by much.
Okay.
This is the issue which we are facing right now.
Okay. Sure. Thanks a lot.
Thank you.
Thank you. Any participant who has a question may enter star and 1. Next question is from the line of Sameer Dalal from Natvarlal & Sons Stockbrokers. Please go ahead.
Yeah, hello. So my question was in regards to the ramp up of the capacity. If we were to, my thought process is, if we were to ramp up capacity, how much additional fixed cost would we incur compared to what we are incurring now? Say you increase your capacity to 75%, or is all the fixed cost already in place for you to be able to produce up to 75% without any additional cost?
Yeah, all fixed costs have already been absorbed and are reflected, so there won't be any significant change in the fixed cost. And on the other hand, with better utilization of the new facility, the variable cost also will come down. So we, notwithstanding what happens on coal, we expect that our efficiency and our cost efficiency will improve. And probably you would have already observed, even during this quarter, despite all these cost escalations on power fuel, we continue to be the lowest cost producer on all the results announced so far. So up to EBITDA level, we have again registered the lowest number compared to the rest of the industry. So we believe that there is still steam left for cost improvement, which we will show in coming quarters.
Good. So that's excellent. Now, my question is, if we were to ramp up, how much operational benefits would we get to go from the current capacity utilization to the 75%? And if that is the case, if we even just pass on 50% of that and lower the cement prices a little bit, I mean, by whatever the differential of cost savings would be, wouldn't we be in a better position to deliver higher ROE because of the increased volumes and increased profitability? And why are we not taking that step? Because if you look across the board, there are very few cement companies working at under 50% utilization. Most are closer to 73, 74. Why are we not able to reach at least that point?
Yeah, so what you are fundamentally debating is the strategy of sustainability in pricing versus trying to discount the brand and sell it at a lower price. The challenge that you would face in that is that your competition is not going to remain static. The moment you cut the price, there is likely to be a reaction from larger players who operate in our region. In fact, in our region, all the larger players are very dominant, and it will not take them even one day to react on that price and reduce the price. So what will happen is that as an industry, we will bring down the price and not gain anything as a company. We have tried and tested it in the past, and a wrong strategy of trying to buy your market share out of the situation. I don't think we are in a position like Jio where we can push through a lower price and buy the market share. I don't think we are in that position as a company, and therefore a smarter strategy would be that we try to enjoy the higher margins, because as we keep ramping up our volume, our margin profile will continue to improve. And while maintaining the price stability, even if I get a delayed
volume ramp up of about a quarter or two, it is acceptable. But we will be able to net at the end of the year make more money than what we would have done by creating disruptions in our market. So I fundamentally disagree with the strategy which you're saying. Secondly, when you talk about the industry volume or capacity utilization versus ours, we must realize that as a company, we were a 3.5 or 4 million ton company, which has now jumped our volume. We have almost doubled it to 6 million or 6.5 million tons. So naturally, when you have doubled your capacity and you are yet to see the ramp up of that volume, your capacity utilization numbers will appear to be little slower or lower. And as we start ramping up in the next 2 or 3 quarters, you will see an improvement in the capacity utilization also.
So my question comes directly against the point. I agree with your strategy.
One moment. I would just like to add a couple of sentences here is that, as Alok already said, there is no reason for us to kill the goose which is laying golden eggs in that sense, because already the market is giving you good returns at a good price, and it is your home market where you are selling 80%. There is no reason for you to push harder there. Second, and more importantly, is also the fact that whatever is the growth in demand, we are getting significantly higher incremental share in the new demand because of the constraint of supplies by the existing players. And therefore, we have a market which is arising and which is growing in front of us, and we are better participant, larger participant in that incremental demand, which is exactly what our strategy has been.
Absolutely. You kind of answered the question I was going to ask. My question is, how are you going to be able to capture more of the market share in the growing market, given that even the competitors are not working at 100%? So even with demand increasing, they can also increase their production from the 75 to the 78 or to the 80. So how are we going to grab that additional market share that you are talking of, or that you're saying that you're getting already? How is that additional market share working, coming in our favor, if I can ask that question?
No, actually your assumption is slightly misplaced. The capacities which are operating in Gujarat are operating at near 100% capacity utilization. The capacities that you're talking about, who are probably not operating at 100%, are probably based in Rajasthan or in Maharashtra region, which have a very limited impact on the sales in Gujarat. And therefore, there is a significant scope for us to improve our volume share in Gujarat without having to disturb price.
Fair enough. I respect the decision, and we hope for the best for you guys. Thank you very much for the time.
Thank you.
Thank you. Ladies and gentlemen, if you wish to ask a question, you may enter star and 1. Our next question is from the line of Kashvi Bedia from Centra Advisors. Please go ahead.
आपण ज्या व्यक्तीसोबत बोलत आहात त्या व्यक्तीने आपला कॉल होल्डवर ठेवला आहे. कृपया लाईनवर राहा.
Apologies for that. Ms. Kashvi Bedia, could you please proceed with your question?
Yes. Hi, good afternoon, everyone. What is our fuel mix for this quarter?
Sales mix, you are asking in terms of geography, 86% in Gujarat and outside.
I asked fuel mix.
Okay, sorry. Fuel mix. Yeah, fuel mix, we have consumed about 6% lignite during the quarter, and balance 94% has come from Indonesian coal. We have also used a good amount of alternate fuel. More of these has happened towards the exit of the quarter. So the impact is still not fully captured in the last quarter. But yes, lignite is increasing during current quarter. Alternate fuel is increasing proportionately in current quarter in order to offset the coal prices.
Okay. And what is the status of Surat expansion?
Surat right now continuing. Yeah. Sorry, Alok, you can continue.
Yeah. Surat is put on hold till we are able to reach a capacity of about or sales of about 5 million tons. So till then, we believe that there is no point adding more capacity.
Okay. And what is our savings per ton on account of WHRS?
So last quarter WHRS has contributed around 12% of our power generation, and which is a good number given the fact that we are using both lines, and in second line we have still not installed WHRS, and there the waste heat is being redirected into the clinker manufacturing process itself. So we are using the WHRS only in line 1. The contribution was around 12% overall.
Okay. Thank you so much.
Thank you. Any participant who has a question may enter star and 1. Next question is from the line of Nirbhay Mahavar from N Square Capital. Please go ahead.
Yeah. So what is our gross and net debt, and how do you see moving it over next 3 years?
So gross and net would generally be in the range of 1360 and 1330. In terms of further reduction in the debt, we have a very long-term debt, and it is staggered till 2030. So there is no huge one-time outflow of debt repayment in any of the coming years. Current year our principal outflow was only 45 crore, and next year it will be about 85 to 90 crore rupees. So the reduction will be gradual because we have a very long period for repayment.
Yeah, but considering the cash flows you would be generating, would it be fair to assume that will be sub 1,000 crore in next 6 years?
Yes, sir. So, I mean, what I am talking to you right now is the agreed schedule with the lenders. Of course, given better availability of funds, we can retire the debt early.
Okay. And another follow-up on the this strategy of holding prices and not gaining market share. Typically, most of the cement companies, smaller cement companies, whenever they have commissioned a large plant, in short run they have to disrupt market to get market share. So is our strategy more driven by our balance sheet compulsions, and at some point in time we will change it, or this is the way we think about growth?
No, I first and foremost disagree with the assumption that we are losing market share. We are gaining market share. What the argument which is being made over here is that should we ramp up very significantly by disrupting our market prices and stability of the market, which in my opinion worked for the company in the past. We have tried it in the past in 2014-15, around that period, where we gained a lot of market share, but at the end of the day, it costed company quite a lot of money, and net we did not benefit out of it in the overall basis. So it is good to say that yes, we are operating at a very high capacity utilization, but at what cost? And at the end of the day, in the overall basis, if you are making more money, then it makes sense. In my opinion, that is not the case in Gujarat. We are anyway likely to gain market share and volume share the moment demand starts opening up. Q3, as you have seen, has been a sluggish period, and therefore you are seeing a lower volume. But as our plants start ramping up, as demand starts opening up, we will take a higher share of incremental demand, which in effect means we will start getting higher market share. But the focus must remain strongly on maintaining margin profile.
Fair enough, sir. That's very useful. Thank you.
Thank you. Anyone who has a question may press star and 1. Ladies and gentlemen, please note this is a final reminder for questions, and no further reminders would be placed after this. We will take our next question from the line of Keshav Lahoti from HDFC Securities. Please go ahead.
Hi. I just want to ask, as you highlighted that you are targeting, 5.5 million ton of cement sales in next 2 to 3 years. What would be the target for next year?
Again, I believe that demand is something which is not in our hands. But assuming that we go by the prediction of most economists that we are likely to see 8 to 10% demand growth in India, I believe that we will be able to improve our sales by about 1 million ton every year for the next 3 years.
Okay. What was the trade share in this quarter?
Our trade non-trade mix is static as always. We are about 50% trade sales and 70% non-trade sales. Again, I want to highlight that in markets outside of Gujarat, we are predominantly selling non-trade. So Maharashtra and Cochin markets are predominantly non-trade sales. And in Gujarat, we are operating at about 60% non-trade and 40% trade.
Okay. One last question from my side. Have I heard it correct? This quarter, the fuel mix was 94% Indonesian coal, 6% lignite, and AFR would be less than 1%.
Correct.
No, AFR was not less than 1%. AFR was also a good quantum. But in current quarter, these other fuels other than the coal are increasing.
Okay. Thank you.
Thank you. Our next question is from the line of Harshal from MK Global. Please go ahead.
Thanks for the opportunity. Sir, what is the fuel mix we can expect for Q4?
What is the?
Fuel mix we can expect for Q4?
So things are still unfolding, but yes, we are trying to get higher quantum of coal and higher quantum of AFR, alternate fuel, and therefore we believe that at least about 15% will be the non-coal fuel in overall mix, and balance could be the Indonesian coal.
Okay, thank you so much.
Thank you. We'll take a last question from the line of Rajesh Ravi of HDFC Securities. Please go ahead.
Yeah. Sir, my question pertains to this 5.5 million target next 3 years that you're targeting. So any broad sales mix that you're looking at, what could be Gujarat and outside Gujarat sale in this? And how much clinker you are targeting at?
Yeah, so great question. So our view is that while in Gujarat we will continue to be a very disciplined and a committed player when it comes to price stability, in other markets our ramp up will be much faster because we don't have any sales mix, or we are not a player of any significant impact in those regions. So our volume ramp up in outside Gujarat markets will be faster. Overall, in the next 2 or 3 years, we will see that approximately 70 to 75% sales will come from Gujarat, and about 25% sales may come from outside Gujarat market.
And this 5 million ton also includes any sizable clinker, or that would be over and above this?
No, clinker can range anywhere between 500,000 tons to 1 million tons, depending on how the plants and markets are performing. But selling clinker is very easy in today's market.
Okay, so this 5 million ton would be cement, out of which 25% should be outside of Gujarat, and additional 1.5 to 1 million ton is what you're looking at clinker opportunity, both export and domestic. Okay, and this when you go to 5 million, 75% of suppose 5 million ton additionally, you would be looking at like if I look at the last 4-quarter number, you did 2 million ton cement sales, out of which 80% would be in Gujarat. Is that understanding right?
Yeah, about more than 80%, would be closer to about 84 to 85% sales is coming from Gujarat currently.
Correct. So around 1.6 million ton, and now you're looking at almost so 1.25. So more than 3.5 million ton, 3.5 or 4 million ton. So what I'm trying to say is that additional 2 million ton plus volume you're looking to capture in Gujarat market. So market which could be 20-25 million ton opportunity.
Yes. So currently Gujarat overall demand is roughly around 23 million tons. So as you can see, our volume share is very negligible in Gujarat, and so when we see a ramp up in Gujarat sales also, I believe this is a very doable number. In next 3 years, Gujarat may be closer to about 28-29 million tons, and selling 3 million tons in that is not a big challenge.
Okay, and what we hear is that Adani is expected to set a factory in next 2 to 3 years. They're also working on it, and even Sri Digvijay is wanting to expand capacities from the regional players. and even the bigger guys would try to. How would that change the landscape?
So I don't like to comment on what my competition is doing. Everybody will do what they feel fit. But in terms of as a company, what we can control is we can control our internal efficiency. This is the only thing which is in our hand. Neither the coal prices is in our hand, neither the cement prices is in our hand, neither the demand flow is in our hand. So the only thing which we can really put our energy towards is our strength, which is to remain the lowest cost producer. And whichever company comes and participates in the demand of the state or the region, I welcome them. I cannot take all the demand of that region. And so we will continue to focus on our numbers, our strategy, and I leave the rest to the other competition to deal with.
Okay. And one last question on the trade mix. You mentioned you are at 50% static, but if I remember correct, earlier you've been mentioning 35% trade mix overall.
Yeah, so I still saying that we are doing about 30% trade sales and 70% non-trade sales. So we are in that ballpark figure itself. Like I mentioned, we don't do any trade sales. We don't do any trade sales outside Gujarat. So depending on demand in the state, it can vary from anywhere between 30 to 35%.
Okay. Great, sir. Thank you. That's all from my end. All the best. And lastly, sir, is there any commissioning timeline finalized for the clinker and grinding at Kutch?
As I said earlier, we are already testing the various processes and equipment as we speak in current months to check their optimum or peak performance, and we have achieved some of those milestones successfully. So during current quarter, those tests will be completed, and this is that will finalize the date for capitalization.
And this would have given you 60-65% of the current volumes for this quarter, the new plant, primarily on the clinker production, whatever you would be maximizing the new kiln. Is that understanding right?
So it doesn't matter. I mean, whether new kiln or old kiln. Now the issue is that we have a capacity of 6.5 million ton available to the company. The challenge or the focus must be how we can quickly ramp it up. Whether it comes from old unit or new as little bearing. What we can say is that now things will only improve from here because the cost will start coming down because the efficiency of the newer plant will also kick in. The maintenance cost will improve because of better availability of the units. Demand is improving in our region. Coal prices have peaked or are near peak. So again, the shock of energy price going up even further is fairly low. So I'm quite optimistic for the next at least predictability of next 3 to 6 months. I feel that we are in a strong wicket.
And for modeling purpose, when this new line gets commissioned, because you would be capitalizing the production costs and overheads, how much would your employee cost and this other expenses would go up once you declare commercial production?
No, more or less, all the costs are already being absorbed in P&L, so I don't see a significant change except interest and depreciation.
Right. So before EBITDA, all the costs are going through P&L only.
More or less, yes.
Okay. Great, ma'am. That's all from my end. Thank you.
Thank you. We'll take one more question. That's from the line of Yash, an individual investor. Please go ahead.
So, ma'am, just as you mentioned that we are capitalizing some interest amount, so what will be our interest cost going ahead in FY23?
So, for FY23, we would expect something in the range of about 140 plus minus a bit.
Okay, so it would be 140. And what is our average cost of borrowing then?
Around 10 and a half.
Okay, so it's 10.5%. And for our tax rate is also now effectively, it would be somewhere around 25%, right?
No, we are not liable for actual tax. We have a shield there, and what we are providing is only the deferred tax, which is a notional book entry for any future tax impact of availing the tax benefits now. But actually, we are not required to pay tax.
Okay. And so this will go on for like So is there any time limit, like this particular thing will go on or something like that?
We expect it at least for next 2 to 3 years.
Okay. Got the thing. Thank you very much. And the volume numbers that you have guided are impressive, the 5.5 million ton.
Thank you.
Thank you.
Thank you, ladies and gentlemen. That was the last question for today. I now hand over the conference to Mr. Vaibhav Agarwal for closing comments. Over to you, sir.
Yeah, sir. Thank you. I had a few questions, if I can ask. Sir, I missed if you did share on the call the current margin profile in cement and clinker in Q3. Any ballpark numbers you can share how much will be made in cement and clinker if you want to bifurcate in terms of margin profile?
No, what I said, Vaibhav, was that on clinker we have not really made any money. It is very close to breakeven. So, the entire margin which you are seeing is fundamentally on cement volumes only. We had signed clinker contracts in the past, but we did not anticipate this kind of a surge in energy prices. So now we are having to supply at these low prices. Secondly, the international clinker prices have also not moved up as equivalent to the increase in coal prices. So today, if you ask me, as of moment, clinker is not a very lucrative trade. It is okay to maintain your capacity flow, but it is not giving us any significant improvement in the overall EBITDA.
So, sir, is it fair to assume that because you have not made any margin in clinker in the current quarter, your pure cement margins would be upwards of 900 to 1,000 rupees a ton in the current quarter?
Yeah.
If I look at pure cement.
You can do mathematical calculations that way. I mean, whatever margin you are seeing is fundamentally on cement. The marginal impact of clinker sales on the overall EBITDA.
Okay. Right, sir. And sir, also we do keep on the ground check. So we understand that your current new capacity is already touching off.
I don't want to give any guidance on that, but like I said, for us, the units are now equal. It is ramping up fairly well. What I can say is we are ramping up our production units very well. We are reaching in most areas. We have touched the. Hello.
Yeah, yes, sir. I'm sorry. There's no problem.
Yeah. Sorry. What I was saying, Vaibhav, is that I don't want to give any guidance on the ramp up of the unit, but for us now both the units are same. Whether it is new unit or old unit, for us now we have a total clinker available. What I can state and confirm to you is that the ramp up of the new unit is very good. In most areas we have already surpassed the guaranteed figures committed by the vendor. Few more areas are pending, which also we will surpass in the next 1 or 2 months.
Right, sir. And so one comment which you made on the call is about the negotiation and renegotiation by contractors with the government with regard to their existing contracts. So do you also feel somewhere there could be a macro threat to prices given that the price increase in some other regions are very large? So any thoughts on that? And it can impact the job stability also. Any thoughts on that?
I cannot say what will happen in other regions, but in our region, a lot of contractors are facing this challenge because nobody anticipated this kind of increase in cost of cement and steel and various other commodities. Diesel prices have gone up, which impacts their transport costs. Manpower cost has gone up. So we are generally seeing a lot of inflation in the market, and many contractors, when they had bid especially for government projects, they had not budgeted for such fluctuation in prices. So there is a little bit of a back and forth and negotiation going on between the contractors and the government. So I don't think prices of other regions will really have any significance on our region as we have demonstrated in the past.
No, I was asking about government intervention perspective. So they come back to industry to reduce prices.
I cannot say anything on that. But like I said, in our region, the prices have always remained stable, and this is one of the reasons that nobody, neither the customers nor the producers, prefer to have price volatility, and they prefer to have price stability. It is net and benefit for everybody.
Right, sir. Right, sir. Thank you very much, sir. Thank you very much, ma'am. Inma, we may now conclude the call. Thank you very much, sir. On behalf of Philip Capital, we'd like to thank the man of Sanghi Industries for the call and many thanks for joining the call. Thank you very much, sir. Thank you very much. Thank you.
Thanks, sir.
Thank you, sir.
Thank you. On behalf of Philip Capital India Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.